$500 billion. That's how much could drain out of the American financial system every single year. Not from a recession, not from a war, from a single currency shift that almost nobody is talking about. And Iran is at the center of it. This isn't about nuclear weapons. It isn't about terrorism. It isn't about ideology. It's about what every barrel of oil on Earth is priced in, and the empire built on top of that. In 1974, the United States made a deal that would quietly reshape global power for the next 50 years. Saudi Arabia agreed to price all its oil exclusively in US dollars. In return, America guaranteed military protection. Every nation that wanted Saudi crude had to buy dollars first. Those dollars flowed back into US Treasury bonds, roughly $1 trillion annually, just from Saudi Arabia alone. This is petrodollar recycling, and it is the invisible architecture beneath American dominance. Every time a country buys oil, it strengthens the dollar. Every time those dollars return as treasury purchases, America can borrow cheaply, run deficits, fund wars, maintain 300 military bases across the globe, all without triggering the inflation that would collapse any other economy. The petrodollar isn't just a financial mechanism. It's the reason America can print money and call it policy. But here's the thing about systems built on agreements. They only work if everyone agrees. Iran stopped agreeing in 2008. Tehran announced plans to open an oil bourse, a market that would trade crude in euros, yen, and eventually anything but dollars. For years, it was dismissed as a fantasy. Iran lacked the infrastructure, the allies, the leverage. Then came 2012. The United States, along with European partners, removed Iran from SWIFT, the Society for Worldwide Interbank Financial Telecommunication, the system that processes nearly every international bank transfer on Earth. With one move, over $100 billion in Iranian assets were frozen. Not seized, frozen, still technically Iran's money, just completely untouchable. The rial began its freefall. By 2018, Iran's currency had lost 67% of its value, 31% inflation. For an average Iranian family, this was the equivalent of watching $100,000 in life savings collapse to $33,000. Almost overnight, not from poor decisions, from geography, from policy, from a war being fought in spreadsheets and sanctions lists. That same year, reimposed U.S. sanctions triggered a GDP contraction of 4.8%. The following year, 9.5%. Iranian oil exports dropped from 2.7 million barrels a day to under 2 million. Revenue slashed by 70%. Iran's foreign reserves fell to $86 billion, 20% below 2013 levels. But even that number is misleading. 90% of it was inaccessible, locked in accounts no bank would touch. Washington called it maximum pressure. And for a moment, it looked like it was working. But pressure doesn't always break things. Sometimes it reshapes them. Iran adapted not through diplomacy, through a shadow economy the West didn't anticipate. Dark fleet. That's the term for the 500-plus tankers now operating outside Western tracking systems. Ships that turn off GPS, transfer oil in open water, reflag under obscure nations, use insurance from non-Western firms that don't answer to Lloyd's of London. Every year, this black market generates $1 to $2 billion in premiums alone, not for Iran, for the traders willing to move its oil. By 2023, Iranian exports had stabilized at 1.5 million barrels per day, less than before, but sustainable. Enough to keep the regime solvent, enough to prove that sanctions don't eliminate trade, they just reroute it. And here's where America's problem gets worse. The buyers are not fringe actors, they're China, India, Russia, nations representing nearly half the world's population. And they're not just buying Iranian oil, they're building the infrastructure to buy everything outside the dollar. BRICS, Brazil, Russia, India, China, South Africa. In 2023, they announced a coordinated push to settle trade in local currencies. UN, rubles, rupees, anything but dollars. Russia's Gazprom Bank now processes transactions Washington can't touch. China's Bank of China handles shadow flows that never cross Western servers. And Iran, cut off from SWIFT, has quietly become the testing ground for a post-dollar system. Brian Hook, the U.S. official who led Iran policy under the Trump administration, said it plainly in December 2019. Quote, "Sanctions deny Iran its principal revenue source, but they've accelerated de-dollarization efforts," end quote. That's the paradox no one in Washington wants to talk about. Every sanction intended to isolate Iran has pushed it closer to the only countries powerful enough to offer an alternative. And those countries are now using Iran as a proof of concept. Meanwhile, the cost of this financial war is not staying overseas. In 2022, as global oil markets tightened, prices spiked to $120 a barrel. American consumers paid $50 billion more in fuel that year. The money didn't go to Iran. It went to every other producer who could meet the demand Washington had restricted. And it gets worse. According to trade analysis, the severed economic relationship with Iran cost the United States between $135 and $175 billion in lost export revenue. 500,000 American jobs tied to trade that simply stopped. This isn't abstract. These are factories that closed, contracts that vanished, workers whose livelihoods were sacrificed not for security, but for currency dominance. Today, 80% of global oil is still priced in dollars. But analysts now predict that number could fall to 60% by 2030, maybe faster because it's no longer just Iran pushing for alternatives, it's a coalition. BRICS nations are already settling 30% of their trade in yuan and rubles. The euro is gaining traction. Digital currencies are being tested. Every percentage point that slips away represents billions in lost treasury demand, higher borrowing costs, a weaker dollar, a slower erosion of the very mechanism that lets America operate the way it does. And Iran, a country with a GDP smaller than that of Ohio, has become the fault line. Not because of what it produces, because of what it refuses to use. The petrodollar was never a formal treaty, never ratified, never voted on. It was an agreement between elites, maintained through leverage and dependency, and for 50 years, it worked. But systems that depend on universal compliance are fragile. One defector is an inconvenience, two is a problem, a coalition is an existential threat. America's sanctions against Iran were designed to break an adversary. They may have accidentally built the architecture for a new financial world, one where the dollar is just another currency, and the empire that rested on it finds out what borrowing really costs.